very simply, was what we would call the British version of Operation Twist. The British version of Operation Twist happened this morning. Oh yes. What the hell is even Operation Twist? Well, good question. What the hell is Operation Twist, guys? Well, Operation Twist is where the banks come in and do something that they don't normally do. And, you know, banks are predominantly focused on short-term edge of the curve because that's what they control, right? The banks generally, as a rule, are focused in this space here. And they leave this space out here to the marketplace, okay? So this is the short end of the curve, so this is short duration stuff here. And obviously, as you start spreading out to the 10s plus out here, you can start to see that this is generally driven by the market influences. This is driven by market influences, growth, inflation, and all those kind of things, right? So this is generally driven by growth and inflation. It's market-derived information. Now, with the short end of the curve is usually driven by central banks. And this is obviously what we would normally refer to as the STIRS market, short-term interest rate markets. So obviously one of the things that happens is that on the odd occasion, the banks will intervene at the back end here. And what they'll do is they'll buy or sell long duration trade. They'll buy or sell long duration stuff, right? Because what they're going to be doing there is you're going to be changing the net shape of the curve. Because obviously in the world of short interest rates, what's happening? In terms of short interest rates, of course, yields are going very aggressively higher. We know that for sure. So we know that central banks at the moment are on a very, very, very aggressive rate hike cycle, right? If I could spell properly. Rate hike cycle. Now the challenge that central banks have with a very aggressive rate hike cycle is predominantly in what? Well, the problem is that you can't get that amount of growth out of the market when you're hiking the rates so aggressively. You know, because obviously that rate influence starts causing massive problems with, for example, mortgages, right? Imagine your mortgage went from 2% to 15%. How many people would lose their houses? How many people would lose their homes? Well, not the old, you know, pensioners, because they've probably paid off their mortgage a few years ago, right? But certainly the youngsters that have just bought their first house, they're on 90% mortgages or the like, and all of a sudden they end up with a, you know, they might be in 90% mortgages, but they might also be, their mortgage might be 1/3 of their entire income. And now they're paying 2% interest rates, they suddenly find themselves paying 10% interest rates. They can't afford their house. And they end up with what effectively negative equity in the house. They can't even sell the house. They can't afford the house. They basically just put the keys in a post box and they post it back to the bank. And that happens every time we see this cycle, isn't it? It happens every time we see this cycle. Does everybody understand the concept, yeah? So what happens is, when you're going into one of these big ramp-up cycles, there's always the chance of an Operation Twist. Now, it's obviously, we call it Operation Twist because that's the phrase. That's the phrase that the Americans coined for their Operation Twist many years ago, and obviously the Japanese have done it very similar to as well. So what they basically do, or you might see it as YCC. You'll see it sometimes quoted as YCC, which is exactly yield curve control. So what they're trying to do is they're trying to protect the back end of the curve from the ramp up in the front end. So effectively what they do is they come into the back end here and they start buying loads of long-term treasuries. Does that make sense? So the central bank buys loads of long-term treasuries to try and drive down long-term borrowing costs, like mortgages, for example. Now, obviously, if you've got a big ramp up in the front end, and the idea is that the concept here is very, very straightforward, you're going to get a big drop-off in long-term yields. We can all understand what that's going to do to the interest rate curve. it's going to provide us with a huge flattening of the curve, right? It's going to be a very, very substantial curve flattener that comes in from that news, right? Now, this was probably the opportunity of the year for me, because obviously we're bond traders. So this was like the biggest opportunity of the year for me post this data release, this news release that came out from the Bank of England, bearing in mind that we are now expecting a huge flattening of the interest rate curve. Take a look at what happened. And you might be saying, but this is of no value to me. It was massive value to you if you understood it, because you could have sold sterling instead. Sell sterling? Yeah, sell sterling. Take a look for yourself. This is the pound on the news. This is the pound on the news. Now, you might be saying in the first instance, the pound had a very, very strong positive response to the news, because it seemed as if this was a big play, a big bit of operational stuff coming into the markets here to try and assist with the function of the markets. In other words, they were kind of comforted by the Bank of England taking a proactive response to perhaps some market fluctuations. They were positive about the impact perhaps of the idea of driving down long-term borrowing costs, all positive type information, except of course that there is a price to pay for that type of thing, and that is you're going to get a very, very, very flat curve. Well, you wouldn't have thought it when you looked at the curve itself. Well, let's change what I mean by that. Let's take a look at the US 2s 10s. Look at what happened to the US 2s 10s. On the news, we got this incredible flattening developing, right? Absolutely nailed on certain that there was an incredible flattener developing on the 2s 10s. And you're looking at that saying, yep, okay, that's what I expected to see. I want to show you where the real opportunity was, though. So that's what you expected to see, right? You got the huge curve flattening. You might be saying, why did it flatten on the US 2s 10s? Well, if you knew anything about fundamentals, you'd realize that curves basically are universal. The Americans have curves, the Brits have curves, some have more curves than others. It's the way it works. It's just the nature of the markets. Everything has a curve, and generally as a rule, the curves are very, very similar. They've got very similar shapes. They've got bumps in all the right places. We know what a curve looks like. And therefore, we should see that uniformity, because when we see uniformity, we can obviously start to recognize the basic concept of trading. That idea that risk-free assets are universal in their demand or supply. And obviously, when we say risk-free, we're talking about there's no sovereign risk, for example, to those assets. So when we see this, this is about right. This is 100% about right. So obviously, when we started to see that, you're saying, okay, well, this kind of idea here, where was the opportunity? You might say, well, selling sterling, but that's a gamble, selling sterling at that stage. But let's take a look for a second. Let's get rid of sterling. So we now know that this is going to be a big flattening of the markets, guys, right? A big flattening of the markets. Take a look at the UK 2s 10s. What the hell was even that? A bit of madness, right? A bit of madness stepped in. And what happened was the UK curve actually got a really steep response, and you're like, what? Seriously? And we started to work sells. Now I thought it was getting sacked in the early stages of this, guys. I must admit, I thought I was going to get sacked in the early stages of this, because I started to sell the UK curve on this, and I was like, shit, I'm not expecting this to keep going against me here. What the hell was going on in here? And I think, to be perfectly honest, I think I probably started selling there, if I'm being perfectly honest. And I sold, and I sold, and I sold, and I sold the UK curve. Fortunately, we got a big response to the UK curve coming back out. And then what happened to the UK curve? It came back up again, and I started to sell the UK curve when the US curve was falling. I started to sell the UK curve again, started to sell more UK curve, and I thought, this is madness. This is just absolute madness in here. And I sold more UK curve, and sure enough, the UK curve got absolutely obliterated after that selling came in. Absolutely obliterated. Make sense, guys? So it started at 11 o'clock. Started at 11 o'clock on the dot. You can start to see this is just ridiculously overpriced. Do you see that trade, Mike? I know you don't trade curves, but my God. You see that trade, guys, that trade bonds? I know you don't trade the curve either, but how wrong is that trade? How wrong is that bit of business? It's shockingly badly out of line with everything else, isn't it? And obviously the sell-off, as I said, absolutely no-brainer opportunity, guys, no-brainer opportunity. It's not a futures trade, guys, it's a basis trade, so most people wouldn't obviously have access to that trade, but it is what it is. Absolutely unbelievable. So yes, that Operation Twist, that's what it was all about. That's what we've been seeing in here, this Operation Twist narrative. It's not exactly the same as QE. It has some of the impact of perhaps trying to stabilize the market in terms of long-term borrowing. The equities should see it as a little bit of a bullish outcome. The idea of long-term borrowing costs being kept under control on a higher interest rate market is always going to be relatively bullish for equities. So we can recognize that equities, you would imagine, will probably catch a small bid. And you can see that from 11 o'clock, equities did actually catch a relatively strong bid as well. You might have been able to buy some equities based on that rallying. And obviously, you've had a very, very nice buy-side response to that trade. But it's all about the ability to recognize fundamentals again, isn't it? And we've been saying this for a few days now, in fact, a few weeks now, is that it's not always the case that fundamentals drive things, but in the present moment, fundamentals are really, really, really important. Do you understand? Fundamentals are really important just now because there's so many things happening that everybody's kind of needing to know about fundamentals because they are the main drivers, which means relative value studies we've got to be careful with, right? Relative value studies we've just got to be careful with. So we calm ourselves down a little bit, guys. We calm ourselves down a little bit on some of these ideas. Just make sure you don't pass up on the knowledge that fundamentals can give you. The challenge with fundamentals is usually it causes spikes and you can't trade the spikes. But sometimes you can. This morning you could, knowing that sterling was going to get mauled because of it. Knowing that sterling was going to get mauled because of it. Sterling was still running hot at that stage because of the good news that they felt was coming out. Well, I felt it was good news, but I also felt it was selling sterling, sell-side sterling, and there was a nice opportunity to sell into that same storyline in sterling. And sure enough, another 200-odd pips sell-off. Another 200 pips sell-off. So does this mean that the Fed are now, the Bank of England are now going to do even bigger moves in the front end of the curve? Perhaps, right? So because they've done Operation Twist at the back end, it opens the door to potentially take away or add a lot of pain at the front end because they think that they've controlled the long-term borrowing costs. Now they can ramp up the short-term interest rate. So there is a chance now that that could cause a 100 to 125 basis point rally. But obviously, the more this goes on, the more you start finding that the central bank is operating against the government, and the government's operating against the central bank. And I think there has to be a sit down at some stage to say, wait a second, guys, wait a second. Let's deal with this because we seem to be taking with one hand and just giving it back with the other. Let's deal with this. And there has to be some sort of coordinated strategy between fiscal and monetary policy. Some people say monetary policy should be left to float because obviously the idea is that fiscal policy needs some sort of redress or some sort of balance from an independent central bank. But then that's the point, isn't it? What's the point of having fiscal policy if it has an impact immediately from the monetary side? And simply any benefit you get from the fiscal side is offset by the monetary side used by the central banks. Maybe you should, maybe you shouldn't. Some people might agree with that, some people might disagree with it, but in these types of situations, one gives and one takes, you end up going round in circles, and you have to have at least a conversation about what the fiscal and monetary policy should be doing together whilst without taking away the independence of the central bank to act, there should at least be, and I'm sure there was a conversation, but the way that the Bank of England acted this morning almost feels as if there wasn't a conversation between the two, and it seems preposterous to think that that could even happen. But you know what? It is what it is. I've seen more stupid things happening in my time. Anyway, how did that buy on gold end up doing, guys? Remember we talked about the buy on gold? How did it end up doing? We bought some gold at 16.31. It's just traded 16.45. We've just made ourselves another $1,400, guys, buying bottom edge gold. $1,400 since we just basically bought that bottom edge price, guys. Unbelievable, wasn't it? Un-bloody believable. And you can see the red line dropping, sell side. Flattens out a little bit. Flattens out a little bit. The blue line's also dropping, so I'm not getting a net value to start selling into this. The first time we saw some net value to possibly start working some shorts was in here, but obviously the red line is still dropping. The red line drops very aggressively there, and now the red line rallied on that candle there. So in my opinion, that's the end of the gold move right there. In my opinion, that's currently the end of the gold move. So you close out your gold trade at 44s, you say thank you very much, end of story. 44s. We just bought 31s. We've just made $1,300 profit on a live trade that we just talked about in the room. And that is exactly why this little piece of information is absolutely golden. It is a gift from me to you guys if you want to use it. It really is that outstanding. And look at what's happened since that 1644 short came in. It's dropped down now to 16, touching into 1642s. It is a great trade, but I don't know how many people use the gold-silver auction, but it is one of the lines that we've introduced many, many years ago to anybody that trades gold. And it seemed as if very, very few people were actually taking advantage of it. And I don't understand why. It's a market internal almost. It's a little bit more internal than gold-copper, but you know, it is a great line to be aware of, guys. It really is a great line to be aware of. We'll no doubt revisit it in classroom this afternoon, guys. We'll revisit it. How did our buy on bonds end up doing as well, guys? Remember, buy side gold, buy side bonds. How did that end up doing? We talked about bidding into the 16s. We had a nice pullback. We've since had a very nice lift all the way up to 135.20, guys. $1,000 plus change. $1,000 plus change, guys. Woo-woo! Pretty good. Pretty good. We do like that type of trade, guys. We do like that bit of business, that's for sure. Now, in macro trade areas, we are seeing this bubble forming on the real yield narrative. Sorry, not real yields, absolutes narrative. And we should always be aware when that starts to form that there's always going to be that negative impact. So if that bubble forms here, as soon as that bubble starts to collapse back in, that's probably going to start collapsing back in there as well. So a nice opportunity, just based on this story, just to book some of that big candle profits into that move. We talked this morning about volume profiles, another thing we should be paying very, very close attention to, volume profiles. We covered it in classroom yesterday, but I want to touch on that as well again in today's classroom. We want to go back over the volume profile, but I want to look at it from the cash market open basis. I did send a tweet out for you to check back on the London market open using profile, and if you've done that exercise, you might have got a few little shocks about what the volume profile looks like. You got a few shocks perhaps because it gave some incredible trade areas. So we'll cover that in classroom this afternoon as well, guys. In terms of data this morning, there wasn't actually much in terms of data this morning. We are Wednesday the 28th. We saw German consumer climate numbers coming in very, very poor, minus 42.5. Can it go any lower? Well, of course it can go lower. But when you look at it historically and you think to yourself how good everybody's doing at the present moment, just cast your eye at this consumer climate number, guys, and tell me just how good the consumer climate for the world is at the moment. ever since 2020. Is it getting better? I mean, it was the German consumer climate seemed to be doing very good through this whole phase, right? Very, very, very strong, very, very positive, very, very bullish, very, very optimistic. And then since 2020, since the Chinese attacked the world with their COVID virus, the consumer climate has been decimated, absolutely decimated here. I mean, wiped out, decimated. I mean, it's getting rotten to the bottom edge, rotten to the core. So consumer climate really in trouble in terms of outlooks, and that's obviously been driven by cost of living crisis, being driven by massive increases in interest rates, being driven by those types of elements, and just that general feeling of uneasiness. You know, the news is constantly droning on about negative stuff, negative stuff, negative stuff. It's difficult for people to feel good about shit, isn't it? Really is. And how dare you feel good when there's so much carnage elsewhere? It's almost one of those kind of things. Everybody's preoccupied with pronouns and the like to take any notice of what actually is happening in the background. So moving on to the US afternoon session, we do have some US news, not at 1:30 particularly. The trade balance numbers, of course, of interest, but you're not as interesting. We really want to get into the pending home sales numbers this afternoon, looking at minus 0.9%. And Fed member Bullard is coming out also at just after 3 o'clock. Always interesting to hear what Bullard's got to say. And then Powell at 3:15 as well. This precedes the oil baron's ball at 3:30. And obviously we'll be watching for the oil inventory numbers. Remember, the key to that is the big supply and demand. The idea is we want to see whether we get the bullish bearish reaction or the bearish bullish reaction. And that means that we're always going to be watching for the secondary release of the distillates and the gasoline stocks. They're the ones that give us the best opportunity to trade, because everybody trades the headline. Everybody trades the headline. The opportunity, therefore, in the headline is zero. So what we've got to try and do is trade the secondary numbers, the distillates and the gasoline. Get a read on those two numbers against a headline that's the opposite, and you've got a great opportunity to make some money on the oil. Have a good one. I'm going to grab some lunch. I'll be back in 10-15 minutes.